and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we are going to take a hard look at the RBI's latest monetary policy announcement, the first under bureaucrat-turned-governor, Shaktikanta Das. And to help me do that, I am joined by a panel of experts. So let me welcome to the show Ashima Goyal, Member, Prime Minister, Economic Advisory Council, Anant Narayan, Professor, SPJ Management Institute, Bombay, and Saugata Bhattacharya, Chief Economist, Axis Bank. Well, the RBI has brought growth back into its lexicon, said one commentator on the monetary policy. And while it's always good when the central bank, which has long been fixated on inflation, turns its attention to growth, the question really is, could it be risking spurring inflation also along with growth at a time when fiscal policy is already expansionary, particularly since the case for growth needing a leg up is frankly quite weak if you go by the GDP estimates. 7.2%, 7.4%, etc. These are hardly signs of a slowing economy. Let me start with you, Ashima.
Yeah, I think that in this case, there is space where the Reserve Bank is just following the inflation targeting framework, and they have inflation forecast numbers which to reflect reality have to come down. When they come down, there's a lot of space opened, a large gap between the policy rate and the natural rate which they want to target. So there is space for a cut. I think even Urjit Patel before he left was saying that there is space for a policy cut. So they are just utilized, and this is something they have to do. The inflation targeting framework they are mandated by asks them to do this given the fall in inflation. Therefore, I don't think that it is especially a loosening step or any such thing. And at the same time, growth is slowing somewhat, and therefore some stimulus to growth is also warranted because of the slowdown in NBFC data, NBFC credit, and because of the international slowdown and therefore export slowdown. All these will reduce demand in the Indian context, and therefore some compensation by increasing domestic demand is warranted. And I think the fiscal stimulus has not been really large because it's very limited, and the payment to farmers and so on comes at a time when food prices are very low. So that will help stabilize food prices rather than create inflation. So in those circumstances, some correction of monetary policy was warranted. Fiscal policy also, because of all the talk about a big package to farmers, what has actually come out is very well targeted and small. So in that sense, again, it's not a major fiscal stimulus, not unlike what happened in 2008. It shows that they're still firm on the long run fiscal consolidation. They've not deviated from that.
Okay. So Anant, I think Ashima took a rather charitable view to my mind of the Reserve Bank of India's action under, of course, the new governor. Would you agree with her?
Well, look, going strictly by the inflation targeting mandate, which is now legislated, one can't fault on the face of it the MPC decision. After all, inflation, CPI headline inflation, which is the object of the target, is close to the lower end of the band of 2 to 6%. And consistently, all economists and the MPC itself has got that the trajectory of inflation wrong. So to that extent, it is not out of order. But I think where the problem starts really is, as you rightly mentioned, the fisc. Now on the fisc, we aren't even sure what the true number is because we know there is obfuscation going on. The headline fiscal deficit that the government has shown is 3.4%, but we know that there seems to be an overestimation of revenues. We know there seems to have been an underestimation of expenditure and off-balance sheet borrowing to hide what looks like actual expenditure of Food Corporation of India, maybe even NHAI and so on and so forth. So the actual nature of the fiscal deficit, we don't even know what it is. And there are some who estimate that the number could be as high as 1% higher than the 3.4% estimate. And it's a cloud of uncertainty. So if you put that in...
So we'll get into the inflation issue of the inflation targeting projections and the quality of the fiscal deficit a little later in the show, because I just wanted an introductory comment by you. So now let me move to Saugata, because Saugata, I know, was along with me not in the camp of those who were asking for a rate cut. In fact, the rate cut sayers were in the majority then, but the minority had argued for a rate cut. So what is your view, Saugata? Are you now justifying it like most people in India? First they will say one thing, then when the authorities go along with something else, suddenly switch sides and say, oh yes, this is the most wonderful thing to have happened. Or are you sticking to your guns and saying a rate cut was not what we needed at this point? Saugata?
Mythili, you're right that I had been arguing that the growth and the inflation numbers and the attendant risks that we see in the system now, probably I think you remember that we were talking about a rate cut in April. If the current trajectory of inflation, other developments were to continue, but not at this point in time, given the various other uncertain factors in the global and the domestic environment. But given this, I don't think that this will make a material difference one way or the other. That is to say, it will not aggravate the risks that the 25 basis point rate cut has brought in. But the question now is how much more room might there be for rate cuts, and what is the need for the rate cuts? That I think is the key question as of this point in time.
Ashima, actually, if you look at the reasons that the bank advanced for cutting rates, they're mostly the same as though they advanced in December for not cutting rates. And when questioned about the rationale, the governor said that oil prices, are lower, inflationary expectations are much lower, and it was as if he was attaching more weight to these than to the budget itself. I know you said its budget is not expansionary, but we really do not know because state governments are offering freebies one after the other. So will these sufficiently offset the fiscal expansion pressures, Ashima?
In India, we don't know what the potential output is. So we should judge it by inflation. As long as inflation is low, since we have unemployment in the system, we should not worry about some government spending being stimulatory. And as I said, since food inflation is really low, transfers to the lower middle class, to farmers, will not be inflationary. They will fall on items, their prices very low, and some rise could actually help stabilize the agricultural distress. So I don't think that this inflation, and the rate cut itself, we are at a very critical juncture, because in 2014 the same thing happened. There was a revival in investment, then oil prices crashed and rates were not cut. Our real rates were very high. And that, among other factors, is fall in global export demand as oil prices fell. It was not compensated by a rise in domestic demand. So the investment cycle crashed again. Similarly, now we have the beginnings of a revival. So I think it needs support from some softening in monetary policy. And just a rate cut, like Sugata was saying, will not be sufficient. What is really required is it has to be complemented with the long-term liquidity provision. And here I think the monetary policy statement marks that in February, for the first time after many months, we've turned to surplus in the LAF, which is a good thing, because too much, in India, some research I've done suggests that the composition of liquidity and matters. Reserve money has a greater impact. So we need durable liquidity in the system to support the percolation of an interest rate through the financial system.
Very true, Ashima. But the problem in macroeconomics is that one could argue equally vehemently on both sides, which is why it makes the task of a body like the Reserve Bank of India so difficult, rather of the MPC. But Anand, the fact is that does a rate cut sit at odds with an environment where there's a huge supply of government paper, and this is going to put enormous pressure on interest rates? So in the process, does it risk damaging the RBI's credibility? Never mind the immediate reaction in the bond markets that yields fell. Clearly, RBI is signaling a decline in rates and the bond markets are signaling a rise. So what does it mean for RBI's credibility, Anand?
I think the problem, Mythili, is that we are now in a period of both fiscal as well as monetary easing at the same time. We can argue about what the degree of easing is, but clearly both are moving in the same direction and both seem focused on growth at the moment. By the way, monetary easing is not just this rate cut. Remember that RBI is doing consistent open market operation purchases of bonds and is going to purchase as much as 80% of the net issuance of Government of India for this particular fiscal year. Plus, it's also giving an interim dividend, and it could also end up giving money out of its balance sheet as a one-time dividend to the government, depending on what the committee decides. All of it are essentially monetary support in one form or the other. I think where the credibility question comes in really is in doing its inflation projections. Remember, in December MPC, the MPC had actually mentioned fiscal risks and had mentioned specifically that if there are slippages on the fiscal front, that might crowd out investment and that might not be good for macroeconomics. Yesterday's MPC, on the other hand, made no mention of the fiscal deficit at all And in the post-policy conference, the Governor Das essentially accepted the government's version of the fiscal deficit, despite all the cloud of suspicion around the numbers, and pretty much brush aside the question of PSBR, etc. But my biggest concern is that we've made these projections for inflation going forward without taking into account what could be the true impact of the fiscal side. And Ashima is absolutely right. At a time when inflation is low, when oil prices are low, when the global context is supportive, Fed is no longer talking about rate hikes. Maybe this is a time to have fiscal expansion and monetary expansion at the same time. But what I don't like is subterfuge. Why hide the actual true extent of fiscal deficit? Why actually not take into account what's happening on the fiscal side in making those CPI projections?
Absolutely, I couldn't agree with you more, and I'm not attributing any motives really. And then what my question is, it depends on how, do you see the glass as half full or as half empty? Because Urjit Patel clearly took a very rigid line. Now have we swung to the other extreme? And that is my question to you, Saugato. Have we now swung from one extreme to the other?
Mythili, so one of the things that you would have noticed, and I think this would have been an important component in both governors persuading the MPC members in shifting their stance, was the survey number on inflation expectation, household inflation expectations, which is something that we didn't know before the policy, which only came out yesterday. You would have noticed the very sharp, the 130 basis point fall in the 1 year ahead inflation expectations, which is something which is a change, because till now it's only been a change of 10, 20 basis points, 0.02%, etc. In all the previous months, the previous surveys. This time there was a very sharp fall. The last time you had seen a fall like this was the post demonetization period. So I don't know what the dynamics are, what has forced or what has led to this change in inflation expectations. From a central bank perspective, inflation expectations are probably even more important than inflation numbers. So I mean, that's one factor that I think has had a role in changing views of some of the members in the MPC.
Okay, yeah, and that's what the governor also mentioned. But if you know how the RBI's inflationary expectation survey is done and how limited it is in its coverage and the total credibility of surveys themselves, I'm a complete skeptic on that, Saugato. But we'll return to this after a short break. Welcome back. You're watching Macros and Mythili, and I'm in discussion with three economists on the monetary policy announcement and whether perhaps the RBI has swung from one extreme to the other, and will we pay the price for it a couple of months or maybe even a year down the line. Ashima, I know you said that the fiscal policy, the budget is not particularly expansionary, and the statement also says that the union budget is likely to boost aggregate demand, but the full effect is likely to materialize over a period of time. But this is equally, if not even more true of monetary policy. So could we possibly get into a situation where both fiscal and monetary policy are pushing at the same time, and we have a repeat of the situation of 2008-9 when growth increased temporarily, but the fiscal deficit also went completely out of kilter. I know you spoke of 2014 and the possibility that keeping interest rates high could have the opposite effect. But what about 2008-9? Is that also not a possibility, Ashima?
Yes, Mythili, I agree that time we had over-stimulus. So I think your characterization of overreaction actually stands to just after, in 2008 there was overreaction. We stimulated too much. And after that, because we had twin deficits, macroeconomic fragility, we swung to the opposite extreme. It was over strict. So I see the current policy as coming to a better balance because the cut is just marginal and there's a lot of space. The inflation and inflation expectations data gives you that space, and the fiscal stimulus also. Okay, all this controversy of whether it's measured correctly, but the numbers themselves currently are just a marginal. In 2008, remember, there's a 4% rise in the fiscal deficit. So now it's just 0.4%. And I don't agree about this extra budgetary resources argument also, because after all, we want to privatize all these public sector. If Air India is getting only 100 crores budget support, eventually it has to raise resources from the market. Eventually it will be privatized. They must learn to borrow from the market, not from the government. And as long as the government does not take this as a liability, as long as private sector is not borrowing or investing, if public institutions are investing, that is a good thing. There are underutilized savings available. Private investment is not forthcoming, so let them invest. They would retreat if private investment came up, if interest rates rose. At present there is space, let somebody at least invest, because the current rise in industry, in cement and steel is because of the government investment in low cost housing. Yeah, so even if they are borrowing to invest, that is a good thing.
I hope you're right on that, Ashima, but Anand, do you see a risk of any repeat of what we saw in 2008-09? Because the fact is that we're pretty close to full capacity utilization, and even though the RBI's policy statement did mention a figure of capacity utilization for Q2, this figure was actually lower than what they mentioned for the same Q2 in December. So the space that the governor says was opened up had not opened up in December, and now suddenly has opened up. So is it as if the monetary policy had decided this is what we're going to do, and now let's look for reasons to justify this? Anand?
Look, the risks are definitely there, Mythili. Look, even in 2008, 9, 10, when the fiscal gates were being opened up and monetary policy was dramatically eased as well, and the order of magnitude was far higher than it is today, admittedly. At that point of time, it looked absolutely appropriate because the whole world was doing the same thing. They were trying to give monetary easing and fiscal space at the same time. Look, I'll tell you where I kind of disagree slightly with Ashima. On the PSBR itself, couple of names, FCI, Food Corporation of India, and NHAI. Food Corporation of India has borrowed 1.96 lakh crores this fiscal alone. NHAI is borrowing 62,000 crores. Now, the fear is that a lot of the food subsidy that ought to be given by the government as expenditure to FCI is not being paid, and instead FCI is being encouraged to borrow in the market. Now, this is not being borrowed for investments. This is expenditure which ought to be paid by the government to its left hand, which is not being paid. And because the government follows cash accounting, it doesn't show it as an expense and therefore shows a better fiscal deficit. Now, that's the fear. I would love the government to come out and clarify that FCI and NHAI borrowing is not of that nature, that expenditure is not being suppressed, and therefore the fiscal deficit numbers are more credible. Otherwise, FCI borrowing alone of 1.96 lakh crores is over 1% of GDP. Now, that's the whole point. If people if there is confusion about the numbers, it's best to come clean and remove the pretense altogether. Even if this is explained, we know there is cash accounting involved on expenditure and refunds and so on and so forth, which can obfuscate the numbers. So the problem is we don't know what we don't know, and there is a fear that there could be a substantial slippage in fisc already baked in. On top of it, the monetary easing is not just this rate cut. It's also the substantial buying of bonds by the RBI. It's also this payment of dividend and maybe a one-time transfer of so-called excess capital and so on and so forth. So there is both happening together, and we'll never know if it is too large until we've actually been flooded by it.
But Sokata, now let me shift to the fact of the current account deficit. The RBI seems to have completely ignored the current account deficit, which at 2.5% as per the CSO is quite high and could be imperiled by further demand pressures. So was this complete neglect of the current account deficit also warranted?
Well, I mean, it's not a neglect in the sense that, I mean, right now the signals are not flashing, probably even amber, and what this is the entire story on crude. And crude permeates the Indian economic story to the extent that, I mean, even a slight deviation from the current $62 levels up to 65 or 66 can potentially put pressure. But I mean, quite apart from the current account deficit, which is obviously, I mean, the twin deficit story. So whenever there's a fiscal slippage, that will immediately translate into the current account deficit, particularly given the household savings weaknesses that we see. But my bigger worry in all of this, I'm sure we will not face the pressures that we saw in 2009-10. But if the data numbers are not significantly right, so either which way, either a strength or a weakness, then this policy might not achieve the results that it's hoping to achieve.
Ashima, let me now turn to NBFCs and the present problems that we are seeing in that sector with once blue chip names defaulting. RBI as a regulator was clearly sleeping on the watch, and in such a scenario, does lowering the risk weight of NBFCs send this wrong signal? Really, it's almost as if you're encouraging bank lending to NBFCs at a time when perhaps RBI should be discouraging bank lending to them. Ashima?
Mythili, I think there are two responses to a crisis. Either you become over strict then, or you take a counter cyclical. When people are in trouble, you allow slightly There's sort of counter-cyclical regulation. The international literature is now encouraging that. So as long as it's sort of market determined, that it depends on the risk rating and so on, I think we have very strong NBFCs. So let that become transparent, which are stronger, which you can lend to with less risk, and let there be freedom in determining those rates. So I think that you need counter-cyclical, macroeconomic, monetary, fiscal should all work together depending on the state of the cycle. So partly because of this NBFC slowdown, we are seeing some slowdown in consumer demand, in credit growth, etc., etc. And therefore you need to take action now when there is space because oil prices have fallen. On the current account deficit, I would like to add that our household savings, investment minus savings is covered, the gap is foreign savings you need because of your domestic savings. Another thing in India was that we always had a very high share of physical savings. So although the savings rate has come down, and it comes down when growth falls, and growth has been low over the past 10 years, but what has happened is the share of financial savings have gone up. So to that extent, the foreign savings we need to finance our investment will be lower. And that, along with the correction in oil prices, will reduce the current account deficit. But I agree that we definitely need to focus on increasing exports in whatever way we can. We need some policies to make our current account, to reduce our vulnerability due to the current account.
Anand, another issue I want to turn my attention to now is the issue of interconnectedness. Will the issue of interconnectedness of financial sector players, banks, mutual funds, NBFCs, insurance companies, pension funds come to haunt us in a big way some months down the line? And is there a sense that the RBI is not doing enough? Because you have banks investing in mutual funds investing in NBFCs, NBFCs investing in corporate bonds, securitizing, banks buying the same securitized paper. And I think the big picture is missing somewhere. Anand?
Well, Mythili, I'll put it this way. Look, there are issues because of interconnectedness, and possibly the soft underbelly is the size of the corporate bond market in relation to the volumes in the secondary market. Look, in your mutual fund industry itself, the holdings of debt paper are about 13 to 14 trillion rupees at this point in time. The monthly volumes you see in corporate bonds is barely 1.5 trillion rupees. You have about 18,000 scrips or individual corporate bonds outstanding, of which only 5,000 trade in a year. So the secondary market volumes simply aren't enough for any large redemptions of mutual funds to actually go through. But at the same time, we shouldn't panic. I mean, this shouldn't by itself cause any panic, because we know that by and large, most of the paper is actually reasonably solvent. There are only a few bad eggs that we have to worry about really. And therefore, even if there is no secondary market volumes, by using some exigency methods and some contingency methods, including maybe RBI stepping in and encouraging banks to do repos, etc., you can handle a short-term problem. So I really wouldn't worry too much about that part. Where I do worry, and I think you asked about this on NBFCs, is the true asset quality. I agree with Ashima that you've got to use counter-cyclical policies. At the same time, there is a trust deficit about the true asset quality of NBFCs. The current financial stability report shows 6.1% or so gross NPAs for NBFCs. People probably think it's a lot higher. So at some stage, we'll have to do an AQR of NBFCs and come clean. Until then, we are kicking the can down the road.
We really should, Anand. And actually, another word for counter-cyclical could be forbearance. That was the word that was, popular earlier. Now we call it counter-cyclical. The problem with all this is very difficult to decide where does one draw the line. Saugata, Anand has been a keen votary of the corporate bond market. I'm not so, because for the simple reason that the larger ecosystem in terms of judicial relays, the quality of rating agencies, all this comes into the issue of, what is the corporate bond market worth? So do you still see banks as essentially the driving force in an economy like India? Corporate bonds are all very well, but for a long time to come, it'll have to continue to be banks. Saugata?
No, you're right. You're right. I mean, generally the principle of rising interconnectedness, that is to say, integration of financial markets is a good thing because that makes transactions more efficient, etc. But that requires a very large ecosystem, the regulatory oversight mechanism, the ratings agencies, the trustees, depositories, data disclosure, etc. We are moving in that direction, but I think, and the regulators certainly must encourage the development of corporate bond markets. But I mean, the truth is that it will take time. and better risk management systems need to be in place. So I think ultimately it comes down to the quality of regulatory oversight, the information disclosure mechanisms, the asset quality reviews, etc., that comes in, so that enables market participants, investors in corporate bonds to get more confidence. So I think that's the area that I think inter-regulatory coordination, regulatory oversight, that's the biggest focus at this point in time.
You hit the nail on the head, Saugata, but Ashima, I'm running out of time. So very quickly, can I just ask you one quick question? That do you think that the Indian economy will continue to be bank driven for a long time to come, at least the next 4 to 5 years, and corporate bonds will take a while before they really displace the banking system? Ashima?
Yes, definitely. That is why the slowdown in credit growth from banks was worrying, because that is the main source of credit and will continue to be for quite some time. But on the whole, some development in markets is complementary, and they can complement each other in the sense NBFCs have some information on cash flows which banks don't use. They have better knowledge of certain businesses. So those kind of complementarities are a healthy development.
Oh yes, some good, some bad, but clearly the RBI's monetary policy is built partly on a wing and a prayer, partly of course on data dependent, though I'm a little skeptical about how the same data earlier justified status quo and now just seems to justify a rate cut, but I could be completely wrong on this and I hope I am. Thank you so much Ashima, Anand and Saugata for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.